Welcome to another segment of Business Breakdowns. I'm really excited for this episode because it is all about financial services, and more specifically about two big companies, JPMorgan Chase and Citi. Namaan and Jenny Ray dive deep into these companies to share how they make money, so you'll get to learn about the business models behind these banking giants. They share key metrics that they would be managing to if they were consultants for these companies or they were operators or on the board at these companies, how to grow, how to set themselves up for future growth. And then they end with a hot take about what they think is next for JPMorgan Chase and Citi. So get ready for a fast-paced overview of the financial services industry, including everything that might be helpful for you to know if you were to come across a financial services client in a case interview. The opinions expressed in this podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, make sure to consult your financial advisor prior to investing. Any past performance discussed during this episode is no guarantee of future results. Representatives of Management Consulted do not own securities mentioned in this podcast. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. All right, let's get into this business breakdown of JPMorgan Chase and Citibank.
What we're going to do first, before we dive into these two companies, is we're going to take a very, very high-level look at how banks make money. And one of the things that Jenny Ray just mentioned rings really true for me as well, which is that when you take a look at banks, they're really like 6 or 7 businesses in one. And often you manage each part of the business really, really differently because they're incredibly diverse in the client base that they serve and in the metrics that they're managed to in terms of what success is. And so what I'm going to do is I'm going to walk through just key lines of business here for banks in general. I'm going to break these down so we're all starting from the same place in terms of understanding and just definitionally. And then we'll dive into JPMorgan Chase first. So the 5 main kind of lines of business at most banks. I'm going to start with asset and wealth management. Asset and wealth management typically contributes a smaller share of revenue at most banks than the other lines of business, but it's steady and it's fee-based. And so if you follow the banking sector, if you follow JP Morgan or Citi, if you're an investor in some of these companies, you'll find that one of the strategic priorities over the last handful of years for these institutions has been to grow their asset and wealth management practices. And so this is where, if Jenny Ray has $10 million and she wants some help investing and managing that money, she might go to the asset and wealth management team at JP Morgan and have them manage that portfolio for her. That's what that division inside of a bank would do. Second, you have corporate or investment banking. I'm going to call this IB as we move throughout our time together today. IB is really about providing strategic advice to companies. It's about helping them raise capital. It's about helping them manage risk, and it's about helping them extend liquidity. IB is really a boom or bust part of the business. When M&A and IPO activity is limited, like what you're seeing in this current environment, this is not as big of a growth driver for banks. And so you need a diversified business to really survive in higher interest rate environments or in environments where IPOs and M&A activity is down. But that's corporate and investment banking. It's probably the sexiest sector, the sexiest line of business inside of these companies. And if you've heard of banks like Goldman or Morgan Stanley, you've heard of them because of the investment banking practices that they have. Number 3 is commercial banking. Commercial banking is really banking and saving solutions for small to medium-sized businesses. You have consumer banking, which is banking, saving, and investing solutions for the individual consumer. And then you have technology, which is really your financial technology. So fintech solutions that are serving both organizations and customers. Think biometric payments, right? Like if you go to a Golden State Warriors game in San Francisco, one of the things that you'll find there is that you can pay with a fingerprint, you can pay with a scan of your eye. You don't necessarily need to pull a physical card out to make a payment. And that's the kind of technology that these banks are working on to reduce friction in the payment process. One of my key takeaways for the industry is just that there's a lot that separates banks from each other when you just compare them against each other. So it's not just how much revenue they generate, it's not just how many assets they hold, but it's also the segment that comprises their core business. And that affects their valuation, that affects their prestige, that affects how much how much pricing power they have. It affects how much they can pay their employees. So Goldman, Morgan Stanley, right, play a lot in that corporate and investment banking space. And so they're different businesses than US Bank, that's much more on the consumer banking side. And so when you examine banks, you just don't want to compare size. You also want to compare kind of what their core business is. And as we move throughout today's conversation in terms of JPMorgan and Citi, we'll be talking about where their core business lies inside of these five segments. Jenny Ray, anything you want to add to this really quick and dirty look of the industry?
Yeah, look, I think that for y'all, one of the things that we want to highlight in this session today is both how banks make money, and also how we would think about helping them improve their performance over time. One of the things that I think makes banks very complex is that these businesses don't all make money in the same way. And so, whereas in the majority of our other practice areas, you might be a group that sells different things or sells to different segments of customers, but it's unlikely that you literally have different businesses inside a single business. And that's one of the things that I think makes banks feel unapproachable and complex. I also, during our session today, I'm going to call to light a bank that I didn't recognize was a bank because I didn't recognize the things that it was doing. It's not on the list of the businesses that we're thinking about. But once you understand like kind of some of the core operating metrics of businesses, I think you start to recognize that there are places and people that are actually valued on their banking process more than they are on what you might see or experience them as you think about using them. So I'll share a little bit about that as we go through it. Namaan, back
Love
to
it.
you.
Love it. Well, let's break down JP Morgan Chase first. This is the largest bank in the US in terms of net assets. It's also the largest bank in the world in terms of market cap. And so a major, major player in financial services. Let's just lay a foundation for where the bank is at today. And so annual revenue, the bank generates about $178 billion in annual revenue. You can find, by the way, all of this information on JP Morgan Chase's 10K. We've even called out the page numbers here for you. So if you want to follow along with us, dig into the bank's 10K and look at what we were looking at as we were putting this together. So $178 billion in annual revenue, $92 billion in net interest income. Now, what's net interest income? Net interest income is the difference between the income you generate charging interest and your interest expenses. So we'll get more into this as we break down the business model. But if I put $1,000 in a savings account at JPMorgan Chase and they're paying me 0.5% interest on that, but yet they're loaning that $1,000 out at 5% interest, the 4.5% spread would be that net interest income. So you can see that just on that arbitrage alone, JPMorgan Chase is generating incredible revenue and profits. Net income overall, $58 billion for fiscal year 2024, and around 320,000 employees work at JPMorgan Chase around the world. If you're an investor or thinking about looking at the stock after today, the ticker symbol for JPMorgan Chase is JPM. Just a disclaimer, this is not an investing podcast. This is not investment advice, but we recognize that some of you might want to apply what you learned today in that vein. So, Jenny Ray, what we typically do on these episodes is we take a look at the business for about 30 to 40 minutes, and we identify from that really quick high-level analysis the three metrics that we would be managing to if we were in leadership at these companies. So I'll kick it over to you to start our conversation off around JP Morgan.
Awesome. Well, the first thing that I just want to do is talk a little bit about the way that the banks make money. But again, I'm going to go kind of segment by segment, the way that Namaan did before. So Namaan, if you want to pop actually back to the last slide, there are a couple of key things that I think are really insightful here. The first is that from an asset and wealth management perspective, now different banks do operate differently here, but the majority of them operate off of a fee for service model or a percentage of asset model. Both of them are usually in the fee for service. It's kind of meant to align with your usage of the bank. In the percentage of assets under management, it's meant to align with the assets that you hold for them. And the assumption is that the kind of larger you are, the more likely it is that they'll have to provide higher levels of service to you. But both of those have a variable component, right? But neither one of those are kind of like a flat rate per year or based on the number of customers that you have. They're based not just on the number of customers that you have, they're also based on the assets that they hold. The corporate and investment banking is usually a fee for service model again, and the fee for service there is on the percentage of the deal that is constructed or completed. That's why you'll see really big payouts in iBanking for the bonus perspective, because they don't actually know how much they're going to make until a deal closes and at a certain price and in a certain time frame. It's a very unpredictable, timing wise sector of the bank. But it is again based both on the number of deals that there are and also the size of those deals. So that is considered to be a variable component of the business. Commercial banking is the one that is probably the closest to a fixed cost type of business. But again, you're going to find the same thing that I've already mentioned. The more customers you have and the bigger they are, the better it is for the bank. And so, when we get there, you'll see that sometimes what we're doing more in that sector is actually lending. There's a variable cost to those funds. That the cost is either the cost of your own consumers' acquisitions or passing through lending that you're doing when you're borrowing from somebody else. So that is again a variable cost section of the business, even though there is from the consumer side a little bit more of a fixed rate. It's less likely that you would see a complete fee schedule that would just be like, hey, it's 10 grand for us to serve you for the year. Consumer banking is quite variable because, again, you're often making a spread on the lending that you're doing. The technology side of the business is really, really interesting. Sometimes there are licenses on that side of the business that are like flat rate licenses for specific organizations. Again, I make my revenue on a variable curve because it's based on the consumers that I have. But that business line is fixed cost. However, it is not dominant enough inside these banks to really shift them to a fixed cost portion of the business. So banks are largely variable cost businesses, and that's going to really impact the way that we think about how we measure the banks, how we measure what they're doing, and how we measure kind of some of their core focus areas. In addition, Namaan called out something really important earlier, and I want to come to it now. The portion of the bank that is your largest by revenue will also heavily influence the way that you make money and the amount of money that you make, both from a margin and from a revenue perspective. For JPMorgan Chase, and this is different from the second bank that we're going to look at later, Citigroup, they make their largest portion of revenue from consumer banking. And the consumer banking portion includes a number of sub things. And if you didn't kind of know what this was earlier, I think it's helpful to know, but it includes things like managing a checking account. It includes mortgage lending to consumers. But it also includes what I think is JP Morgan's kind of secret sauce, which is its card issuance on the consumer side. That card issuance is largely a fixed cost business from the fee side, but a variable cost and variable revenue business from the lending side. So those co-branded cards, the Chase Solo cards, are a big portion of what you'll see their focus is, and a big driver of what has made JP Morgan, ironically, one of the most iconic old investment banks, the bank that it is today. Namaan, anything you want to weigh in on that before I kind of head into metrics? Okay, awesome. Well, when we look at the metrics of a business like this, finance bros love to throw around metrics that are super complicated. And honestly, they're right. Okay. So I'm not going to say that what we're talking about today is more right than them being right. But what they're doing is that they're trying to value JP Morgan Chase. When we think about this from a consulting, from a leadership, from a management perspective, we're not actually trying to value the business. We're trying to increase the value of the business. And so we tackle it from a different perspective. We think about how we're going to improve the profit, how we're going to improve, the returns of the business. And so I want to call out three, what I would consider like kind of vanilla metrics here. Namaan, yours are probably much more finance bro like, but mine are super. I mean, you're even wearing a vest today, dog. Like, what are you just trying to channel the bros? What's going on?
I dressed for the occasion. It's not Patagonia though, so I'm definitely a poser.
I love it. I can't even tell the brand, but we don't need to know. It's you're wearing the cloak. So here's what we're doing. When we talk through the metrics, I just want you to pay attention to how we think about these in terms of how we would manage. So the first and most important number that we're going to care about is the assets under management. Right. And basically, like JPMorgan is JPMorgan, not because it has 5 divisions, not because consumer is the largest division, but because it has the largest or one of the largest assets under management of any bank. We can't even see all of them. Not all of them are publicly owned, but assets under management is the number one driver. That's going to be the thing that drives everything that we do, right? Everything that we do is going to go try to get more assets under management. Every acquisition that we do is going to be trying to get us to more assets under management, because the more assets we have, the more we can charge the fees on them, the more we can deploy them into our mortgage lending, into our card issuance, into our other services, the more that we're able to support the flywheel of the operations that we have inside the bank. So the number one is just assets under management. How do we go get more of them? And if I'm JP Morgan, I'm continuing to think about divisions, i.e. the use of the ventures division inside JP Morgan to try to drive not just AI cost cutting, but actual customer acquisition that is way cheaper than what I've been able to do before, that gives me more of those assets under management. The second thing that I care a lot about is I care about card issuance. So I want to know what number of credit cards I have deployed. And my third metric goes on top of that. So ideally, I'm just like, look, the number of cards makes a lot of sense. But actually, one of the most viable competitors that's ever come up against Chase has been Capital One. And Capital One is, I think, an incredibly fascinating business, because Capital One said it's not just the number of cards that you issue, but it's also the type of consumer that you go after. And so they did really, at the time, a better job of targeting business and middle income card holders that were likely to hold a balance and therefore pay them on the revolving of the balance, but they were also likely not to default. And so Capital One really picked off a customer segment from JP Morgan. So the percentage of balances outstanding factored in on their card business is also a really important metric, both from a risk perspective, how high are we, what percentages of utilization, but also from the actual capital deployed, because the more I get you to use on your credit card, I'm getting fees on the back end from the merchant issuers, and I'm also driving that balance on the front end and collecting the revenue from our percentages that are paid. So whenever you pay a credit card fee and you pay it to Chase, from henceforth, from here, just remember this. That's what they're trying to get you to do. And so that's, I think, a really important insight when you think about those 3 metrics. So Namaan, from a vanilla standpoint, how did I do? Pretty vanilla, right?
Not sometimes vanilla is the best way to look at something. Because you have to strip a business down to its fundamentals. And I think the number one thing, like you said, that JP Morgan cares about is assets under management. I did get a little bit more granular than that. I stayed away from credit cards for
You're
our
wearing
conversation.
the vest. You have to, right?
I did stay away from credit cards for the JP Morgan conversation, because I really want to hit that when we get to Citi. But there are 3 other metrics that I thought about as I looked at the 10K here. So number one was consumer banking growth. So like Jenny Ray mentioned, this makes up 42% of JP Morgan's total revenue. It is the largest line of business at the bank by revenue. And so to her point, the higher your base of assets are, the more interest rate spreads move the needle for you in terms of revenue growth. And so in a high interest rate environment, I'm able to make more on every dollar of assets that I hold. So conventional wisdom has always said, in a higher interest rate environment, that's not a good environment for banks to operate in. I could not disagree with that more. in an environment like we're in now, I am actually able to raise the spread between what I pay for a deposit and what I collect on a deposit. And so, for example, right, if I'm going to put $1,000, in a JPMorgan savings account, and they're going to pay me a 0.5% interest, APY, what is that? That's $5 a year. But if they're going to then take that $1,000 and lend it out at 5% interest, the 4.5% difference between what they're paying me and what they're earning is the interest rate spread. And so I would be, to Jenny Ray's point, really thinking about increasing my base of assets, specifically, in consumer banking, where I don't have to pay a lot for them, because that'll move the needle for me, not just in terms of revenue, but in terms of margin as well. And I think this is one reason why JPM is really zigging where others are zagging. One of the things, if you've been following the company in the news, that you will remember is that they are really expanding their pace of like retail bank location openings. So they are opening retail bank branches when everybody else is shutting them down. And I think that the reason they're doing this is because they understand that they have to continue to grow in this consumer banking segment to generate some of this incredibly healthy margin on this consumer banking revenue that they're already generating. And so I think this is one zig where others are zagging that's really going to end up paying off for them in the long term. Now, when you're the largest bank in the US, you have a little bit more dry powder to be able to open new branches and to be able to manage the fixed cost of that. But they're really, I think, strategically deploying that capital to continue to increase the advantage they have in that business segment. So that's number one. It's consumer banking growth. Number two is sales and trading fee revenue. And so this is specifically inside of that investment banking vertical. There are really three ways that JP Morgan's going to serve its clients inside of that vertical. They're going to do underwriting. They're going to conduct trades, or they're going to make a market, or they're going to conduct advisory services for their clients. And so I'd be focused on a couple of different things inside of that investment banking or that sales and trading vertical. Number one, I would really be pushing to win underwriting contracts this year because IPOs are few and far between. And so I really gain a competitive advantage if I'm able to position myself as an advisor to clients who are navigating a very uncertain M&A landscape. I earn advisory fees, which are high margin. I also earn underwriting fees, which are also very high margin. And then the third thing I'd be focused on inside of that division is that I'd be focused on buying and selling securities and seeing if I could profit from their price fluctuations. So this is what's known really as market making. And so when you are in a stock market that is high volatility, like we're in right now, you have the ability to kind of buy in and hold certain securities. And then when the price fluctuates, sell it at strategic times. And again, make a nice little spread on that purchase. There's a team and a division inside of JP Morgan that's already doing that. I'd be focused right now in a volatile market on ramping that activity up. This division overall accounts for 20% of JP Morgan's revenue, but because of the reasons I've just mentioned, I expect it to grow in the next 12 months.
If you're enjoying listening to this business breakdown and learning how Namaan and Jenny Ray approach business problems, then you might benefit from the Black Belt program. Black Belt is a structured case prep program designed to help you build business acumen, crush case interview prep, land an offer, and get promoted. The program is built around 8 hours of one-on-one coaching with an MBB consultant, plus a world-class digital resource library. Our Black Belt cohorts have limited capacity each month, so don't wait around. Learn more and join today at the link in this episode's show notes. Hey, Strategy Simplified, are you ready to land your dream consulting or corporate strategy job? On the Management Consultant job board, we've made it easier than ever to do just that. Create your free job seeker profile today and instantly unlock access to hundreds of top-tier job opportunities, all at no cost to you. Don't wait. Start your journey towards your dream career now through the Management Consultant job board. Your future in consulting is just one click away. Find the link to create your job seeker profile at the link in this episode's show notes.
The third and final thing that I'd be focused on is growth inside of my asset and wealth management practice. This right now only makes up 13% of JP Morgan's revenue, but as I've already mentioned, it's steady revenue. Whether you're in a bull market or a bear market, whether you're in a high interest rate environment or a low interest rate environment, this segment of the business generates repeatable, profitable, predictable fees that can help see the bank through different economic environments. And so one of the things that I really value as I run a business or advise a business is steady, predictable, repeatable revenue. And that's exactly what asset and wealth management is to JP Morgan. And so strategically, I'd be looking to grow my base of assets inside of that line of business. There's a lot more that I thought of. There's a lot more that I could have looked at. But when I just had to boil the business down to a couple of levers that I would try to pull to grow in the next 12 to 18 months, January, this is what I ended up coming up with.
Namaan,
Anything you, yeah, go ahead.
well, yeah. I'm just, I'm like, I think you said it, but I want you to say it again, and maybe in a different way. But like, what ties all three of these together? What's your North Star? Can you just kind of tell people like, okay, like if I don't do this, we're dead in the water? Because I think sometimes that's where we get confused, is that we think, hey, we should do it all because we have to do it all. But I think there's a theme across the three of these that you didn't like, you called out, but maybe just call it out again.
Yeah, I mean, I think the theme is you have to increase your asset base, and everything flows from there. Like you said, it feeds the flywheel. I'm able to then exponentially scale, right, the revenue and the margin that I'm generating from the spreads that are available to me, both in kind of the credit market, in private lending, like in all the different things that JP Morgan does, right? Like their biggest profit driver is that interest rate spread. And so the more assets that I hold, the more I'm able to lend, the more I'm able to lend, the more that I'm able to profit from the difference between what I'm holding and what I'm lending. And a better way to say it is what I'm paying out on those assets and what I'm generating on those assets.
I also really liked your point about the fact that that like when prices go up, sometimes people increase the charges. This is a complete aside, but I think it'll be interesting for the purposes of this. I had a friend who owned gas stations, and a couple of years ago, I said, how do you decide what you're going to price your gas to be? And he was like, I always try to find the median price in the market, and I'm $80. I'm 80 cents above it. And I was like, 80 cents. Like, I thought that gas was kind of a race to the bottom and you'd have a convenience store. And he said, honestly, I found that when I really understood my customers, they were highly inelastic. I was already 20 cents cheaper. So I wasn't getting the customers who were the bottom feeders who would drive 40 miles across the area in order to get the cheapest gas. They weren't the people that were the most price sensitive. Like, they were getting gas on their way somewhere. That was it. And so I just recognized that I could jack up the price and just make margin where other people wouldn't, because they didn't expect me to be the cheapest. And I think that that's environmentally kind of what we're saying about something like banking, is that like, you're not expecting it to be the cheapest. You're especially not expecting right now for it to be the cheapest. And so you're getting mortgage rate shoppers, for example, who are just like, well, I missed 5%. Now it's probably better than the next time. But if you're a quarter or half of a percent higher, you're making good margin on that in a way that you weren't before.
And I'll just say this too, right? Like in the gas station business, right? It's location, 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 right? In financial services, a lot of it is around brand, and brand can become a moat for you, and brand can become a margin driver for you. And I'd say, especially in kind of the investment banking division, and perhaps even commercial banking, there's like a safety that comes from working with JP Morgan, because it's a 150-year-old brand, that you might not get from working from a fintech startup. And so I think that brand also allows JP Morgan to extract like additional points of margin from almost every line of business that maybe Citibank, who we're going to talk about next, doesn't quite have that same luxury to do yet.
Well, let's talk about it, Namaan. From a hot takes perspective, you want to go first? You want me to go first?
I'll go first. So one of the things I mentioned at the beginning is this is not an investing podcast. It's not investment advice, but I just couldn't help but think about the share price of JP Morgan as I was looking at the business. And so my hot take, my prediction is that by the end of this year, you'll see an all-time high share price for JP Morgan. It actually achieved its all-time high just literally 30 days ago. It's about $280 a share. As of earlier this morning, it was at $233 per share. But when I looked at the business, when I looked at the profit margins, when I looked at its competitive positioning versus its peers, I just don't see how by the end of this year, JPMorgan Chase isn't again trading at an all-time high share price.
Okay. We should probably have you disclose whether you're an investor or not in JP
I,
Morgan Chase.
I'm not, but I might be later this week after just doing a little bit of a deep dive into the business. Yeah.
I don't own any individual stocks, so I'm not. I have no horse in this race. But yeah, I think that's a great one. My hot take is that we're going to see a major change in the next 12 to 18 months in the way that JP Morgan does venture. Historically, venture was really utilized to try to drive costs down and to keep competitors from having a technological advantage. I think that in the future, we're going to see tech inside the banks like JP Morgan take early and aggressive stakes in businesses that they already expect they're going to acquire, noting that the acceleration of time to market is really moving up. So instead of expecting that you're going to invest in the seed round and then there's going to be a series A and a series B, I think they're going to move to acquire in the first 6 months and roll out and deploy technology. And I think that that technology is going to be largely focused on consumer acquisition in a way that it hasn't been before. I think historically it's been in back office operations. It's been in maybe managing some kind of consumer branding, but it hasn't been in just going out and getting customers. So I mentioned earlier that there's a business that I wanted to highlight that isn't one of the two banks from today. Like the first time I actually figured out what banking was about a year before I met this business. It was when I was in business school, and this business is Acorns. If any of you have either invested with Acorns or downloaded the app or used it, it was basically a way for you, in the same way that you have the opportunity at almost every checkout everywhere to round up to a charity, you could round every purchase that you made, usually on a credit card, into or on a debit card into an account. So they would round up to the nearest dollar and pull that money in to automate investing for you. And it was kind of a way to gamify investing, and it offered surprises. I think you're actually going to see technology like that at the higher end levels. Like, go give me your 401k and we're going to gamify it, and we're going to play out in 3 scenarios if I'd had your money last year, what it might have done. And I think we're going to see this customer acquisition, robocalling, the use through these branches of giving psychological safety of people putting your money with you, aided with AI that feels super real, to continue to drive those assets under management for a bank like JP Morgan. So, yeah. So, Namaan, yours is very concrete. Mine has a little bit of a longer window, but I hope that in 12 months we'll be able to put out Namaan's prediction came true. I think you may or may not see the effects of mine, but I would really be interested to see if both of these are a part of the future for JP Morgan.
I think yours makes a lot of sense to me. I think what I hear you saying is personalization at scale and increased velocity towards some of these investments that they may be making at a slower pace right now. I think
like
that
historically they've been like, look, we'll be one participant in a tranche of 20, and we'll wait 12 to 24 months until we decide the next amount of money that we put in. I think now it's kind of like, I want to see it in a month and I want to buy you in 2. And I think we're just going to see venture in these fintech and spaces like really, really accelerating, led by banks like JP Morgan.
I love it. Should we dive into Citi, or should we take a little halftime break and answer some questions? What do you think?
Yeah, let's take a quick halftime break on questions. And then I don't know if Katie Neff is here. Katie was here, but she may have had to drop for another call. Japheth, if Katie's not here, would you just kind of run through what we actually do at Management Consultant, especially for new listeners? Welcome to anybody who's new.
Yeah, for sure. Thanks both. I'll give you a quick breather here. Yeah, so for those of you who don't know, while we love doing business breakdowns, we love breaking down these companies, these industries. What we also do is we help people become consultants. So we help you break into the consulting industry, and perhaps in consulting, one of your clients will be JP Morgan Chase or Citibank, et cetera. But we've got just a couple of great programs here to help you navigate that transition into the world of consulting. And so just really quick, going down this list here is 1 hour coaching. So if you've got an interview, right, with a firm like McKinsey or Bain or BCG, or even in internal consulting, you're like at an American Express internal strategy group, something like that, right? You need a little bit of help to get over the hump and make sure you're prepared for interviews, right? Book a 1 hour session here with us. For a more comprehensive program, Black Belt is our most popular option for you, and that's going to give you full support through from resume and cover letter edits down to 8 hours of interview coaching with an MBB coach and more. And then Super Prep here is just everything that Black Belt gives you, but a lot more coaching hours as well as some consulting experience to add to your resume. So scan the QR code here and then check out the links in the chat to learn more about that, those options here today. All right. You guys want to take some questions?
Let's do it.
Let's do it.
We have time for two.
Two. Great. We had folks pre-submit questions, so thank you in advance for sharing those. Let me pull down here. All right. How do Citi and JPMorgan differ in their approach to investment banking and wealth management?
I have no idea. I haven't been a customer of both of them. And I think that's really like one of the only ways that you can think about it. I mean, we could look at the relative sizes. I didn't break it down, Namaan, you may have. But in general, honestly, like there's two fun factors that are at play here that I would say, and then Namaan, I'll let you weigh into. Investment banking and these kinds of services are incredibly commoditized. Like the job that you do is literally exactly the same. The way that you do it and who you do it with is incredibly tailored, which is honestly very similar to how consulting works, right? So like, when you're thinking about hiring somebody in a consulting space, you have a question and you need to have an answer. And the way that they answer that and how they work with you and who you're actually interfacing with and whether you like them or not becomes a big driver of how the work goes. So you have these really kind of two interesting pieces of advisory services like that are working together. But in terms of their actual approach, I would say that the commoditization would drive them to be incredibly similar. I think it's harder to figure out how they're different. Namaan, what about you?
No, I'd agree. I mean, I think the approach is very, very similar. The success is what's different. So we're about to dive into Citibank here in a minute. We'll see that Citibank's about half the size of JPMorgan in terms of annual revenue. And I think when you look at prestige in the investment banking space, it's certainly true that JPMorgan has a little bit of a higher prestige level than Citibank, but in the way that they would operate and execute, I don't think there'd be much difference at all. I will say asset and wealth management is incredibly relationship driven. So if I'm working with a wealth manager at Citibank and they end up moving over to JPMorgan, I'm following the person, I'm not following the brand. And so these firms really invest heavily on the asset and wealth management side in protecting and strengthening and deepening those relationships that they have with family offices and high net worth individuals.
Yeah, the last thing that I would just say here is if you're thinking about working for either one of them, you're going to, at the junior level, get incredibly similar skills, right? You're going to have to hustle. You're going to have to go figure out how to sell a book. You're going to be pitching products. You're going to think about how customers work, and you're going to learn systems. Like Namaan said, at the senior level, you're going to have a different brand expectation behind you, and you're probably going to win more business the higher the brand value is. And we would find that the same, which is what drives talent to companies like McKinsey or Bain or BCG, instead of boutiques in the space. Boutiques have often the same amount of value to offer and are often fantastic to work with, but it's just easier to sell work if you don't have to make an excuse for working with that organization. Japheth, is there another question?
Let's dive into Citibank, and then we can end with a few more questions at the end.
Sounds good.
Love it. Well, Jenny Ray, do you just want to walk us through the key stats here for Citibank?
Yeah, you bet. So Citibank, I never thought you would say that 81 billion looks small, but it sure does when you put it next to to JP Morgan. And so, these revenue numbers don't make any sense because they're not really like total revenue generated. I mean, the bank's whole business is to generate this. Really, like the margin spread is the number that makes a lot more sense. So net interest income is 54 billion. The net income of the bank is the 12.6 billion number. Still not terrible. People are still getting bonuses, and your house in the Hamptons is fine. But it is different. It's at a different scale. Looks a little bit different. Also, this number of employees, right? 229,000 employees. So if you run a couple of quick calculations per employee, you've got a different number than you did for JP Morgan. You also have a different amount of money falling from the net interest income down to the net income line as a basis of percentage. And we're going to walk through some of the individual pieces of the business to help you understand why that's the case. Also, such a flex. Citi has a New York Stock Exchange ticker with a single letter. I think anytime you get that, you're in great position. So letter C if you're looking up more information about Citi. Namaan, do you want to dive a little bit into Citi's business model and specifically tying it back to some of the segments inside the business?
Yeah, so I won't repeat a lot of what you said for JPMorgan Chase because the business model is very, very similar. You have certain lines of business that are higher fixed cost lines of business. Like those would be your kind of your commercial banking. You have higher variable cost lines of business like your consumer banking, your investment banking, et cetera. And so I know you just did a breakdown of that 5-10 minutes ago, so I won't rehash that. But I will say that overall, Citibank is more of a variable cost-based business than a fixed cost-based business, just based on where more of their revenue is generated from. And that's what I want to dive into here over the next couple of minutes. And so when I looked at the 10K, when I looked at the business, there were really three key metrics that I wanted to pay attention to. And I had to pick different ones than JP Morgan. Otherwise, we're going to have the same conversation twice. So like at Citibank, I just want to lead with this caveat. Yes, we do care about our asset base. Like we care about growing our asset base. What I did here is I did a little bit of a deeper dive into two specific segments inside of Citibank's business. And I was like, okay, how would I grow these strategic segments based on what's happening in the economy right now and based on what's happening in the competitive landscape? And so one of the things that I actually identified is what you mentioned that Capital One has done a really good job of, which is acquiring high FICO card users. And for anybody who doesn't know, FICO is just the organization that gives you your credit score. And so what I'm saying here is acquiring credit card users that have higher credit scores. And so why did I pay attention to this? Well, when I looked at the quarterly earnings, I noticed that Citi's credit card revenue was $2.7 billion in the fourth quarter of 2024. It grew by 8%. And there's really two distinct drivers of credit card revenue. It's spend volume and it's new signups. And so what I'd be looking at if I was Citibank inside of that line of business is driving new signups from folks who have credit scores that are higher than 740, 750. I think that's a good proxy for kind of, your top quartile in terms of, income in the US. And a recent analysis by Moody's showed that the top 10% of consumers in the US drive 50% of the spend. And so as the US consumer weakens, generally speaking, how are you going to keep spend volumes high? How are you going to keep revolving balances where you want them? You're going to acquire customers that have higher credit scores. And that leads directly into my second metric here, which is their net charge-off rate. This is the risk metric for the customers that you're acquiring and you're serving. It's the loans that people don't pay back, the loans you have to write off. And so this rate was 6.5% in the fourth quarter of 2024. That was a nearly 2% increase year over year. So that tells me two things. Number one, overall, maybe the consumer is weakening in terms of their spending power, their budgets are getting tighter, but it also tells me that Citibank maybe doesn't have the strongest profile of consumer to begin with inside of their customer base. And so I want to make sure that I am kind of maximizing spend volume as much as possible, that I'm signing up as many new credit card users as possible while minimizing this net charge-off rate. And then the third thing I'd be looking at, if I was at Citibank, is a little bit different. I'd be looking at growing my trade and working capital solutions group, which is a differentiator inside of Citibank that I haven't really seen play a central role in the operations of other banks. Just a little bit of context for you. Citi is the number one trade finance partner for institutional clients in North America. It holds 20% global market share in the payables finance space. And so we are right now living in a world of a lot of trade uncertainty. And so Citi has the opportunity to step in and provide digital first solutions to help organizations streamline, optimize, and bring clarity to their processes and decision making around international trade, around kind of cross-border payments, etc. And Citi also has the opportunity to provide working capital to new organizations that might have to pay attention to trade in a way they didn't have to before because of kind of the tariff environment that we find ourselves in right now. And so I think we're starting to see early momentum in this area for Citibank as well. Their cross-border transaction value surged 6% year over year last quarter. And it was a $93 billion revenue line item for them. And so I could see them doubling down in this area of expertise inside of our current economic environment. And I think this could be a big differentiator for them. Those are three of the things I'd be looking at, January. How about you?
I love these, Namaan. Look, I'm simple, and I really don't like vanilla ice cream, but today I'm just straight up vanilla because it took me such a long time to figure this stuff out. If you want to pull up the categories for business, I didn't know this actually about Citi. But again, like one thing that makes the business is not just the business, but it's what they do differently, or they're a little bit bigger. And a lot of the kind of commercial banking sector, which Citi thinks about commercial and the corporate and investment banking kind of in a very similar way, is a larger sector of their business than the consumer focused portion. And you know, you have two choices when you're thinking about a bank when you're in that position. Do you grow where you think the market is, or do you grow where you think your strength is, right? Do you kind of double down and triple down in the areas where you're already strong, or do you position over time into the growth sectors of the market? And I think Citi has faced this choice before, and kind of just looking at the history. And I think the decision they've made is to double down. And I honestly can't tell you that that was the right decision for Citi in the past. No, and I'd love for you to weigh in a little bit on this when you think about the history, just based on some of what you said. But when I think about it, it's kind of three things, right? One is assets under management. I think they looked at a metric before and they were like, the revenue per customer and assets per customer are higher in this segment, right? But actually, it doesn't get you to higher assets under management overall. So I think sometimes that could be an example of how you could drive decision making inside a bank the wrong direction, because you look at something that makes sense and has made sense for you and does make sense on a per effort basis, but doesn't necessarily move the needle kind of in the long run. The second one that I think is just in terms of their average size, like Namaan talked about brand prestige earlier. I don't have the data on this. I couldn't find it, but I suspect that the revenue per customer in that segment is actually lower than our peers. So even though it's a larger segment, I bet that we're losing on the contracts we really want, and not, and what we really want to do is we want to win on those contracts, and we want to win on other contracts because it's a core of who we are. But if we're not able to get prestige because of our focus on that area, I don't know if we're actually getting the kinds of customers that we're looking for. So revenue per customer slash asset management per customer on our commercial side is to me super important. And then the third is new customer adoption, right? The rate of new customer adoption, which I do think is in banking and financial services is a proxy for brand strength. Right. So, you know, it's actually not the number of customers that you have today, which was what my former metric lent into. It's the growth rate of your customers in a market that is growing, as people are actually not just banking with one organization, but diversifying their banking needs, and specifically niching down into some of these key areas. So you're probably still only going to have one bank for your business. But you may have a portfolio of products on the consumer side. And I think that some businesses have really, jumped on that a little bit more. Namaan, any reflections on that? Again, I'm not trying to be too vanilla, but thinking about, hey, like, how is Citi where they are? Are they happy with where they are? Where are they likely to go? I recognize that it's actually not as clear as like grow from your strength in the same way that it is for JP Morgan.
Yeah. A lot of what you said resonates with me. I'm just thinking back to the GFC, the Great Financial Crisis, and I think one of the things that hurt Citi that they honestly haven't recovered from until very very recently is that they had high exposure to mortgage-backed securities. And so they took a big hit during the GFC. I think that there was a reorg that happened. They might have even spun different parts of the business out. I'm going off memory here. It's been almost 20 years. And so someone can correct me in the chat or they can send us an email if I'm wrong about that. But that to me is the root cause of a lot of the comeback that Citi has had to make over the last 2 decades was their exposure to mortgage-backed securities. And so I think that's also one of the reasons they might have been gun shy in some of the sectors, January, that you were talking about, is because of what happened in 2007 and 2008. I know there were more regulatory constraints that were most likely put on them as well. And so kind of you combine that element of kind of conservatism, you combine additional regulatory constraints, and I think it makes sense, at least somewhat, why they focus their business in the segments that they have.
Yeah, absolutely. Well, Namaan, what's your hot take for Citi?
I'm gonna stay on the investing theme just to tie these two companies together. I mentioned I really like kind of JP Morgan stock. I think in this space, as I was just doing a little bit of digging today, I probably like Citibank's the most. And so the reason being, number one, the CEO, Jane Fraser, who's actually a former McKinsey consultant, by the way, has one of the things that she's done during her tenure is that she's really focused on spinning off non-core parts of the business. And so for Citibank, like non-core meant a lot of non-US parts of the business. So they're winding down operations internationally. They're refocusing on their core segments in their core market. And the board just authorized in the first quarter of this year a multi-year $20 billion share buyback program. And so when you are kind of right-sizing your business, when you're refocusing on your core operations, and when you are reducing the number of outstanding shares that you have, available, that to me, like as a novice investor, right, spells like share price going up. And so, kind of my prediction that who knows if it's going to come true or not is that it'll be the best performing big bank stock for the rest of 2025, and we'll find out in 12 months if that's true or not.
My hot take is that consumer outpaces their corporate division by the end of this year as a percentage of revenue. I think that the advantage of growing and refocusing growth into a core market is that you pursue higher growth opportunities. And it's not like they're not already currently there. We haven't seen a lot of Citi co-branded partnerships, for example. I think we're going to see more of those. I think we're going to see growth not just in the consumer division, but also in direct lending. I think Citi does have the cachet to handle that really effectively. And I don't think you see it in Middle America. I think you see it in New York, and I think you see it in LA. I think you see it in not just some of the core markets in terms of the US. I think you see it in areas where there are also currently strong and have a presence. But I do think that focus is going to lead to that sector of the business overtaking the other one. Come on, tie it all together. Put a bow on this, baby. You've got the vest on. It falls to you.
All right, I guess I'll take the responsibility.
I brought a jacket to a vest fight. What do I do?
You're outgunned. I think key takeaway here is that banks are incredibly complex businesses, but it's that complexity and diversification that actually enables banks to have 100, 150, 200-year track records. Because when your business is diversified, you're able to survive any kind of economic environment, and you're able to build a brand that acts as a moat for future generations. And so I think when you look at banks, when you look at banking, you can't just look at surface level headlines and say, okay, investment bank revenue is down. That means that JP Morgan's suffering. Well, it's a little bit less intuitive that actually 42% of JP Morgan's revenue would come from the consumer banking side. And so you have to really examine banks as businesses within a business. And hopefully today has helped you start to think about that in a different way.
Well done.
Japheth, I'll turn things back over to you. We can answer questions for a couple of minutes. We can have a conversation with folks. If you disagree with us, let us know. But we'll stick around for a couple of minutes to have that conversation before we sign off for today.
Amazing. Well, thank you to both of you. So we can take questions in a couple of ways. So number one, just type your question in the chat here on Zoom. And number two, type your question in the chat on YouTube, LinkedIn, Instagram, etc. And we'll take as many as we can with the last 3 to 4 minutes here. Namaan, I know you were going back and forth in the chat about a couple of questions or anecdotes here. Is anything you wanted to add or just kind of reiterate that you think would be helpful for the group here from those?
Yeah. I got two really great comments / questions inside the chat. Number one was just around, hey, like if Citibank acquires high FICO card users, why are they still facing a higher level of default? And kind of my answer was, I think the reason they're facing a higher level of default is because they're not targeting those high FICO card users right now. And so that's the segment inside of the credit card user base that I'd be going to target, not just to reduce my net charge-off rate, but also to increase the spend rate on my cards. Because a follow-up question to that was, wait, high FICO card users are going to be less likely to carry balances. How do we make money on them? Right? And great question. The answer is you might not make money from interest rate, revolving balances or from late fees, but you will make more money from spend volume because Citibank earns a percentage of every transaction that you spend on a Citibank issued credit card. And so those high FICO card users spend more. They also spend more during economic downturns. And because of those two reasons, we have a predictable, steadier kind of revenue coming through that card business because we earn a percentage of every transaction that they're conducting.
I mean, Namaan today, one of the takeaways, I always think about like, what would I do in this situation? Namaan was like, hey, you could buy stocks. That's what everybody could do. I'm just like, who's going to start the next card issuer, right? You look at this and you're kind of like, you make money both ways. You make money if you don't pay, you make money if they do. There aren't a lot of businesses out there in the world that manage that kind of cachet. And I do think that the area is pretty ripe for disruption. There hasn't been a lot of disruption in that space recently. And I think there could be a disruptor in the next year or two that would make a huge difference and a huge dent in managing both of these assets under management and that kind of relationship. And you would be not just a strong solo performer, but also a key target for someone like Citigroup, I think.
I think a harbinger of that is just the explosion of private credit that we've seen, right? You're seeing
Correct.
more and more high net worth individuals, more and more businesses looking for liquidity, getting funding from non-bank sources. And so eventually what's going to happen is that's going to move downstream. And I think you're right. In the next 3 to 5 years, we'll start to see more and more of that targeting consumers like us.
Well, thanks everybody for joining us. Hope you really enjoyed this conversation. We always ask you for who we should talk about next, and y'all came up with this one today. So come on, make it a little easier on us next time, not 5 businesses freaking rolled into one. But if you have companies that you're interested in that you'd like to learn a little bit about, we don't know anything. So maybe we said something smart, maybe we didn't today. This is the highest of high levels that we look at when we're looking at these organizations. And there's a lot better resources if you want to do deep dives that are out there. But we do try to keep it limple. We do try to keep it simple and strategy simplified. So if you want that same treatment for another business that you admire, we'd love to hear about it. Thanks again for joining us.
Thanks for tuning in. If you've got a company or an industry that you would love to see profiled in a future business breakdown segment, please let us know. Email us team@managementconsulted.com to submit your request, and we'd love to cover it in a future episode. Thanks for tuning in. We'll catch you on another episode soon.